So let's just start there. Sharon mentioned your critique of the Fed. I think it's important, given the Fed has been in the driver's seat for the markets pretty much the entire year, and the economy as well. You recently made a lot of news coming on CNBC saying what you think the Fed is doing is, quote, suicide. And I think my biggest question is why you would say that when we're running inflation rates we haven't seen in multiple decades.
So it goes back to what was the cause of all this. We printed record stimulus in a manner, in a quantity that the world had never seen before. At the same time, the supply chain broke down. Too much money chasing too few goods. Everyone's buying whatever's on the shelf. You were buying watches, used cars, everything went bananas. Now that is completely reversed. Before the Fed even began to raise interest rates, the savings rate has dropped from 33% to 2.5% now, which is as low as I think it's been since 2004. And instead, the consumers are now galloping on their credit cards. They're maxing out on their credit card receivables are going through the moon. So the consumer is out of money. You have the opposite situation in the macro. You have too few dollars now chasing too many goods, because all the retailers and all the suppliers, they thought that pandemic demand was going to last forever, and so you see inventories going straight up. So what you see right now, forget about what the Fed's done, which is a total debacle in itself. Prices are falling. Used car prices are falling. Our oil prices are falling. They're below where they were pre-pandemic now, and pre the energy crisis in Europe with the Ukraine. So the nation is correcting automatically from the excesses of the pandemic. Now the Fed decides to show up very, very late to the party, not paying attention to what's actually going on, that prices were going down. Wages have accelerated. I like wages going up. That's great for our country. And now they seem to be measuring their success by unemployment rates and reducing wage growth and pressures on wages. But that is a good inflation. What we don't want is goods inflation, and that is reversing. And the other thing I brought up on your show several times is the biggest component right now of inflation, of CPI, is the rent component. And rents, they're looking at data that's a 4-month lag. What they're reporting, and it's the biggest number last month, is actually 4 months old. Rents are actually rolling over and beginning to decelerate in the United States, and obviously we have a very good view of that. So there's absolutely no doubt, 100%, that inflation will be going down in 4 or 5 months. And I think increasing rates now is backward looking, because you're disrupting not just the United States' economy. You're shifting capital out of a new plant that might get built. What you're going to see is a plant that's under construction is going to get finished. An investment in an office building that's under construction will get finished, has to get finished, so the jobs are there. But there'll be no new buildings, no new plants, no new microchip plants if people can't borrow money at attractive rates. And the banks are kind of frozen with the Fed's movement. The banks are like, we don't know what to do. And they're not lending. And spreads, the money we borrow out, the spread over the relative rate has tripled. AAA bonds in real estate have gone from about 80 over the curve to 250. So the cost of capital has gone through the moon at a time when we should be investing in long-term growth for the country. So for us, it's also, the Fed's movement is affecting not only the dollar, which has soared to record highs, it's backed off more recently, but also all the economies of the world. So we put the entire world into recession as they have to increase interest rates rather than have their currencies collapse against the dollar. So dollar strength means exports aren't going to be that strong either. And at the same time the Fed has been increasing rates, they've also been selling off the balance sheet, which is a double whammy. And they did this and had this plan before the Ukraine crisis, which actually disrupted everything even further and is really the source of the big inflation you see in Europe. And the danger is the politicians, they want to make everyone happy. So when a union contract comes up and they say, oh, inflation is 8%, so we have to have an 8% wage growth. That's how you actually lock inflation to the system. But they're looking at inflation that in many cases I think is transitory. It can become more permanent if all of these union contracts get reset to the temporary aberration that's being created by all this money that drove prices up, which is now reversing because there's very little savings. They're on credit cards. The consumer cannot keep this up. And these buildings that are finishing, and we're finishing buildings ourselves, we can't start the next apartment complex. We can't start the next office building. We can't build a hotel because the equation doesn't work. Remember, replacement cost is going up. Prices have gone up. Wage rates are going up. So we have to build to yields that we can't make work with today's rents, and we stop construction. So the economy is going into a recession, and it's absolutely definitive. You can look at the yield curve. The yield curve is the steepest it's ever been. So, I mean, it's a record steepness, and so the markets have voted.
So, Barry, you know what you need to do? You need to give these notes to Senator Elizabeth Warren, Senator Sherrod Brown. They're trying to argue that the Fed is doing too much. You're doing a much better job explaining why you think that's the case. The problem is, or problem for your point of view, is that this is not where the Fed is right now. And in fact, they're going to raise again 50 basis points next week, probably. We're going to get a few more, possibly above 5% into next year. And they could hold it at that restrictive level. So are you saying you expect a worse recession than maybe what the market consensus is?
I actually think the steepness of the yield curve tells you they could really create a serious problem, deflation. That if I'm right, that this consumer's out of money, and now they're going to take all the money out of productive uses and put it into bonds because you're going to buy bonds at 5%. It's not good for the economy, and it's not good for the equity markets. And so prices fall, companies' margins get compressed, and you see a very serious problem. One thing nobody ever mentions about the Fed rates is that the biggest borrower in the world is us. We have a $32 trillion deficit, and we're decreasing revenues to the government because the equity markets are falling. Home prices are coming over hard now, and that's one of the biggest markets and the biggest part of the net worth of the consumer, of the American, is his home. So he's not feeling really bullish about spending money when his home price is going down. He can't move because his mortgage would be 7%, his existing mortgage is 3%. So he's staying put, but his home is going down in value. And you're going to see jobs loosen up. There won't be quite the demand. It's inevitable. And the Fed is really overdoing it. I'm rarely in my 35-year career post-business school, I've really felt that people aren't paying attention to the $32 trillion deficit. Let's take your $32 trillion times 5%. It's not all rolling over today. That's $1.5 trillion of interest expense. Last year it was $400 billion. That's a five-fold increase in just the interest on our deficit. So they're killing themselves. They're going to have to continue to print more money, which is going to force rates up to pay the interest on the deficit. So when have you ever seen the IMF and the UN ask the U.S. to stop increasing interest rates? Because we're crushing emerging markets. We're crushing the small countries. Nobody can do this, otherwise their currencies are going to go to oblivion and beyond.
They've got a serious credibility problem if Jay Powell goes down in history as the guy who lost the fight on inflation. Because there's evidence that our economy, all that pent-up demand, it's strong. And the only thing they know how to do to get prices down is crush demand.
Yeah, I think the economy was fixing itself automatically. What you saw in Black Friday and was it Cyber Monday, that was all driven by retailers driving discounts through the channels. And I myself bought some stuff online because it was so cheap. So I mean, I really think I think we'll see how this all plays out. Pardon me?
What did you buy? Kitchen appliances? That was the deepest discount post-COVID.
I bought some furniture actually.
There you go. There you go. So, people aren't investing in their home as much, as you said.
Yeah, I think. Look, there's also opportunities for investors in all this. I think if you look at real estate as an asset class, we're gonna adjust to a new interest rate environment. But it's very interesting to look at the 10-year at 3.6 and the 1 year at 4.80. If you believe that 3.6 is the interest rates for long term, real estate at 5 yields looks pretty attractive, 5.5, because it's an inflation hedge. You're getting a better yield than governments, and you have a hard asset that has value, especially for lumber, labor, and everything else is going up in cost. So real estate is going to have an adjustment period, but the better asset classes, particularly those that can mark to inflation, which are apartments, to some extent hotels, and industrial, they will do okay. If you have to take a long-term view, no bell's going to go off and say the Fed is done. As soon as the bell goes off and the Fed says they're done, or you see the weakness, so the Fed has to stop, which I think you're going to see, then I think real estate as a body catches a bid, and it really is. It's not right now. There's too much fear, and there's too much, and then the fear is creates great opportunities for investors. And what we try to do in times like this is we find great assets that have the wrong balance sheet, or in the public companies that you think will get acquired because they're getting in trouble, but they have great businesses and they have the wrong balance sheet, or they're in an inopportune time that's increase in rates hit these companies. So I think if you comb through the debris, investors will get very good opportunities to find places to deploy capital.
Are you talking about distress? Do you expect a bigger distress cycle? And what sort of businesses are you looking at?
Oh, yeah. Absolutely. I mean, in markets around the world, there isn't an asset class that isn't impacted by the move in rates. And I think people on your show, they're quite academic approach to this, but I have people that are I'm looking at a building we're in our New York offices today, but I'm looking at a building out my window that we're a lender on. We're the senior lender. There's a mezzanine position and there's the equity. I can tell you the equity is probably gone. The mezzanine probably owns the building, and they're going to be there's going to be a lot of that. There's going to be a lot of reshuffling of the chairs, and the lenders are going to find themselves with a lot of assets because borrowers don't have the money to. By the way, it isn't the absolute level of rates. It's the pace at which he went. The increase, 6 successive increases in rates in a row, now 7 if you're right, and he goes up in December. That's unprecedented. Real estate markets have absorbed 2 to 5% increases in rates over 3 years, no problem. We actually had that in 02, I think it was 02, 03, 04, 05. But this was vertical,
and
no markets can't adjust to that. Yeah, it's too fast.
Four triples with the 75 basis points.
What it creates is a lot of uncertainty. And people don't know how to price things, right? Because you don't know, are you right? Is he going to go to 5.5? Is he going to go to 6? Or is he going to go the other way? He's going to go to, are we going to see the curve shows rates lower at the end of next year? I think they'll be materially lower at the end of next year. I think short rates will be down significantly. I think Powell will see that they blew it. And I hope the only good news about him going up is the back end is faster. Like it won't drag on so long. I mean, the one thing that's screwing up my theory here is how many jobs remain unfilled, and they remain unfilled because we don't have the workers to fill them. And I keep imploring the government to let these worker visas through. There's 1.8 million worker visas in applications sitting on desks in Washington. That number could be usually 400,000. So increase the supply of labor. Let these people in so I can hire them in our hotels, in restaurants, in shops, at airports, and help increase the supply of labor to help reduce the pressure on wages. And you'll get the results you want in a much healthier way than having to have people unemployed. And the reason this is so bad and why I call it an assault on capitalism is if the Fed's goal is to increase unemployment, throw millions of people out of work, have wages go down, inflation won't come down as fast as they'll lose their job. They'll go on unemployment. They'll basically, now we'll be paying them on unemployment with a $32 trillion deficit. It's only going to go up. And they're going to say the system is broken. Like, what kind of system is this? I just got a job, and I just got my wage from $17 to $22, and now you're throwing me out of the job. And then, they're going to say capitalism is broken, and no, the Fed is broken. Capitalism isn't broken. The Fed is broken, and he's not. The fact that the government isn't using real-time data to drive the economy. Are you kidding me? Are you kidding me? Seriously, today? Really? So,
I mean, you're in the hotel business. How
the
high
rent
are you charging
complex
for
is the
hotels?
most obvious. Sorry.
How high are hotel prices right now? You're in that business. It's booming. There's no recession. It's not being impacted by weak consumer.
That's true. I mean, hotels are booming, and I'm as astonished as you might be because it's not just the hotel price. It's how did they get there? Look at the airline fare. Right, it's and bookings are strong, and I don't know if it's the tail end of the pandemic behavior, if people are the one last shot at the ski trip or the trip to Miami, but globally there has been a very rapid increase in hotel rates, and even in New York, even though occupancies are not back, it's one of the few cities in the United States, New York and San Francisco, where occupancies are not higher than they were in 2019, but rates are, and so the overall revenue per room is higher. And that's because, in New York, it's two things. People aren't back in the office to the extent they were. So the midweek travel is not there. You have to go see the company, but it's not physically here. And two, the currency. Foreign travel to New York is down about 80% from international because, first of all, the first half of last year, they couldn't come. In the second half of the year, the dollar is so strong, nobody needs to come shopping on Fifth Avenue anymore. So it's a very I think everything you got to be careful about looking in the past. You got to use common sense and look forward and what's the likely outcome. I just saw a memo from the nation's largest developer saying, hey, we have to reprice everything we're doing. We have to slow down. We can't start construction on these 50 projects because we're not going to sell them at the prices we thought we were going to sell them before. That's a recession. You're not going to buy a car because you can't afford the loan. You're not going to buy a house or the home building. The home building industry is in a recession. That's a pretty big industry. So it is black and white, and a lot of what you see, including the jobs reports, are we're still trying to finish the buildings we started. We have projects under construction. We're opening a hotel in Hawaii in February. We're going to finish it. Everyone's employed, and when we're done, then we won't be doing another hotel in Hawaii anytime soon. So, I mean, it's
really interesting.
It seems fairly obvious.
Why? I mean, you talked a little bit about investor sentiment and especially retail sentiment. Wanted to bring up the REIT, which is very hot right now. This idea that yours and the Blackstone non-traded REIT that invests in apartment buildings is limiting withdrawals. Why? Why are people pulling their money out? Hasn't this been a really good performer?
Yeah, maybe that's why they're pulling some money out. Both the REIT and the REIT are up like 9 and 10% this year, and people don't understand that GAAP accounting requires us to mark the debt we have in place or the caps we have in place to market. And in both situations, both firms have significant caps. So we have basically fixed our debt for 4 to 6 years. In our case, we have caps at 1% on LIBOR and so forth. They're worth a lot of money. So almost half of the gain you see in the portfolio's value this year is actually the value of the debt we have in place. And we don't want to market. We have to market to market. So we're not happy about it. It's actually required by GAAP, and that's how we report. The other growth is that we've actually bought the best markets and the best asset classes. We're in the Sun Belt and apartments, and the two REITs, REIT and REIT, look very much the same in that regard. They're slightly different in locations, and one has a little more affordable housing. They have a little more student housing. We don't have any student housing. But the entities are the same. So what happened is, of course, people say, hey, there's press about why are these up when the public REITs are down. And that's actually the reason people do these non-traded REITs, because they kind of hold their NAV. They don't trade to 20% premiums or 30% discounts. The markets overreact, the public markets, in every direction. That's what sort of makes them fun to invest in. But people can lose money when the fundamentals are still in place and your rents are going up. And we, in the middle of the pandemic, we raised about $800 million in a week or two to buy equity REITs, because they were so oversold in the market, and that fund returned 65%. So the public markets just got it wrong. And in this case, what the investors are doing, we can't produce our dividends, which are around 4.5%, and they're almost completely tax sheltered versus buying a treasury. We can't produce that without putting the money in property. So we held about 90% in assets and 10% in liquid securities to handle redemptions. There are caps, which the SEC is enforcing, on how much investors can take out. It's 2% a month and 5% a quarter. And that's because we can't just sell assets willy-nilly to meet redemptions. We want to protect all the investors. These vehicles are solid. They're paying, there's no issues with their dividends. I'll speak to REIT. I don't know that much about REIT.
Right.
But they're paying their dividends. They're secure. I mentioned the caps in place give us confidence we can pay these dividends for the foreseeable future. And this is in the best interest of shareholders, of all our shareholders, which are smaller investors, to manage liquidity for them. And I think, there's a lot of noise, a lot of press, and people think this is a run on the bank. This isn't a run on the bank. I mean, we have real property producing real assets. This isn't FTX or anything. There's actual cash flow behind. I don't know the aggregate. It's a $30 billion portfolio of property that was cherry-picked, we thought, for long-term performance for our investors. I think REIT feels the same way. So, it's really a question. I think short rates went up. People say, hey, I got a good gain. And in some cases, international investors have gains in the currency. And they're saying, okay, I got my 10 or my 9, and I got another 3 points in the currency. Nothing I own is up 12%. I'll come out and I'll come back in later. So, we'll manage this as best we can, and it's okay. It's the product. It was sold with these restrictions in place, and they obviously make sense. And the SEC said to both us and the whole industry, we want you to follow the letter of your documents. We don't want you to do 3% one month and 0% the next month and 1%. It's too chaotic. So follow the guidelines. And we were in discussions, both of us, with the SEC about honoring redemptions and what they wanted us to do. And they had firm opinions. So they don't want this to be treated like it is. They want us to follow the letter of our documents, and that's what we're going to do.
So no, it gets punted month by month. So, okay, fine. Barry, we're out of time, but I just have to ask you, you've painted sort of a bearish, gloomy picture of the economy and the consumer, said, though, that there are a lot of investment opportunities. I'm curious what your number one, highest conviction 2023 bet is.
That's interesting. Do I have to tell you?
Yeah.
I'm interested in Japan.
That's why you're here.
It's one of the few countries in the world that still has a spread between the yields on property and what we can borrow at. And particularly interested in things like the hotel sector, because the yen is so weak that I have a feeling when the Chinese leave China again, which they will eventually, they will go to Japan and buy everything that they can carry back to China. So I think Japan is an interesting bet right now for investors.